At 9:17 a.m., nothing looks wrong. The coffee machines are humming, markets are open, payrolls are scheduled, cargo ships are unloading. Somewhere, a small committee votes to move a number by 0.25%, 0.25%. A tiny switch. By lunch, billions of dollars will change direction. Within months, companies will freeze hiring. Within a year, an entire economy can stall. Not because factories disappeared, not because people forgot how to work, but because the price of money changed. And almost no one feels it when it happens. Right now, that small switch matters more than ever. Governments are carrying record debt, households are stretched, companies refinanced at rock-bottom rates during the easy money years. The system is stable, but only at the current settings. Change the setting, and everything recalculates. So let's break down what that switch actually is. It's the interest rate. More specifically, the benchmark rate set by central banks like the Federal Reserve. When the Fed raises or lowers rates, it's not just adjusting numbers on a screen. It's changing the cost of borrowing across the entire financial system. And modern economies run on borrowing. Think of money like oxygen in a room. You don't notice it when it's abundant, but reduce the flow just a little, and suddenly everyone feels tight in the chest. Here's how the chain reaction works. Step 1, the central bank moves its rate. In the US, that's the federal funds rate. Banks borrow from each other overnight at this rate. Step 2, commercial banks adjust their own lending rates, mortgages, car loans, business credit lines. Step 3, everyone else recalculates. A family thinking about buying a $400,000 home at 3% interest faces a monthly payment around $1,700. At 7%, that jumps to roughly $2,600. Same house, same salary, $900 difference every month. Suddenly, that family waits. Multiply that hesitation by millions of households. Home sales drop, construction slows, furniture orders decline, appliance factories cut shifts, truck drivers haul fewer deliveries, local restaurants see fewer customers. One small switch. Now zoom out to businesses. For a company, interest rates aren't just background noise, they are the cost of expansion. Imagine a manufacturer that wants to build a new $50 million plant. At 2% borrowing costs, that investment makes sense. At 8%, the math flips. Profit margins shrink before the building even opens. So the CEO delays, then cancels, then freezes hiring. When enough CEOs do that at the same time, you don't get a slowdown, you get a stall. But here's the uncomfortable part. The economy isn't just affected by interest rates. It's leveraged to them. Over the past 2 decades, global debt has exploded. Governments borrowed to stimulate growth after the 2008 financial crisis. Then came the pandemic. Trillions more were created to prevent collapse. In 2008, U.S. federal debt was around $10 trillion. Today, it's more than triple that. Corporate debt followed the same path. Household debt hit record highs. That debt was manageable when rates were near zero. Zero is a beautiful number when you owe trillions. But raise rates to fight inflation, which surged after pandemic stimulus and supply shocks, and suddenly interest payments balloon. The U.S. government now spends hundreds of billions annually just servicing its debt. Not building roads, not funding research, just paying interest. That's the irony. To cool inflation, central banks raise rates. But higher rates increase government interest expenses. Larger deficits can force more borrowing. More borrowing can keep upward pressure on rates. It's like trying to lose weight by lifting heavier groceries. And then there's the banking system. Banks don't just store money in vaults. They invest it, often in bonds. When rates rise quickly, bond prices fall. That's basic math. In 2023, we saw what happens when that math catches up. Banks holding long-term bonds purchased during low-rate years suddenly faced massive unrealized losses as rates climbed. Most survived, a few didn't. Confidence leveled. And confidence is the invisible layer holding the system together. Because here's what people forget. The financial system runs on expectations. If businesses expect rates to keep rising, they stop investing early. If households expect layoffs, they cut spending preemptively. If investors expect defaults, they demand higher yields. The freeze can begin before the damage is visible. That's the power of the small switch. Now let's contrast the hype with reality. When rates go up, headlines frame it as discipline, responsible policy, fighting inflation, necessary medicine. And sometimes it is, but medicine has side effects. Higher rates don't just punish speculative excess. They squeeze first-time homebuyers, small businesses with thin margins, governments funding social programs. Meanwhile, large corporations with strong balance sheets often survive just fine. They locked in cheap debt years ago. They have cash reserves, they can wait. So the pressure concentrates in specific places: housing, startups, highly leveraged firms. That's how stress builds quietly. The economy doesn't usually collapse in dramatic explosions. It slows in increments. A delayed project here, a canceled loan there, a hiring freeze that spreads across industries. GDP doesn't fall off a cliff overnight. It bleeds. And because monetary policy works with delays, sometimes 12 to 24 months, central banks are always steering using old data. They raise rates based on inflation numbers from months ago. By the time the full effect hits, the economy might already be breaking hard. It's like steering a cargo ship by looking in the rearview mirror. Too little tightening and inflation runs wild. Too much and growth suffocates. Now zoom out even further. The global financial system is interconnected. When the Federal Reserve raises rates, capital flows toward the US seeking higher returns. Emerging markets feel the squeeze. Their currencies leaken. Their debt, often denominated in dollars, becomes more expensive to repay. One country's small switch becomes another country's crisis. We've seen this pattern before. In Latin America in the 1980s, in Asia in 1997, in parts of Europe after 2008. Different decade, same mechanism. Cheap money fuels expansion. Rates rise. The leverage reveals itself. The uncomfortable truth is that modern economies are structurally dependent on relatively low borrowing costs. Growth over the past 15 years has been partially built on the assumption that money reeks no expense. When that assumption changes, every valuation model, every government budget, every real estate price gets recalculated. That recalculation is not emotional. It's mathematical. And math is indifferent. So here we are. Inflation forces central banks to keep that small switch higher than markets would prefer. Debt levels limit how high it can realistically go. Political pressure builds. Markets react in real time. The system doesn't break instantly. It tightens. It creaks. It slows. All because of a number that moved by a fraction of a percent. Factories still exist. Workers still have skills. Ideas are still there. But when the cost of money rises enough, activity pauses. The question isn't whether the switch matters. It's how long an economy built on cheap oxygen can function once the flow is restricted. And when the next adjustment comes, up or down, will it be enough to stabilize the system? Or will it reveal just how fragile that stability really was?